often the money will be consumed during your lifetime. You've essentially converted an asset that was fixed and illiquid into very liquid assets, assets that you can consume and use up in a way that you would not have wanted to with a family business or certain other types of assets, real estate, etc. So there is an opportunity to utilize the assets that you receive in a way that you could not without this transaction. That's an additional factor that's at work here, sort of incentivizing these efforts. But what you don't use up will be in your estate at your death. But if you've done this correctly, you'll have substantially less in your estate than you otherwise would have. Remember the other thing we're betting on. We're betting on assets appreciating. You've selected an asset that you suspect is going to appreciate at a substantially faster rate than the money will, or the rate of interest will be on the discount that you get on what you receive. Now, I hope that makes sense to you. In other words, you use an interest rate inherently when you're calculating installment sales or you're calculating annuities. You got to use some sort of rate, and often this is called a discount rate. Well, if your rate of appreciation on your asset is above that, then you win in that bet. If it's below that, then it may not have been a good idea unless there are other factors such as the minority discounts, etc., that are at work. Hopefully this makes sense to you. So let's talk about the income tax implications of these types of transactions. Let me start by pointing out that the asset that you decide to transfer, whether it's real estate, whether it's a small business, closely held business, that is generating some level of income. And it's probable that that income is substantial. So the net result of this transaction may be that you're receiving less income after the transaction than before. So the effect of that is that you've deflected some income. You've deflected it to others, perhaps family members, whoever is on the receiving end of this transaction, so that the income tax that they receive may in fact be at a lower marginal rate than would have been if you had received it. So this is a factor that, while it's perhaps not the centerpiece of this transaction, it is something that you need to consider. So these sort of differences in rates between this family member that you may transfer this to and you could be significant, and particularly if these marginal rates spread out. They're fairly compacted right now, so that we have rates that creep up fairly rapidly, then they settle out at around 35–36%. We know soon that that's probably going to change. As presidential administrations change, I suspect that rates will creep back up, and as they do, this becomes a more important consideration. So issue one is the income that's being generated from this asset is being transferred from you to the other person. Now, what about the implications for you since you received this annuity, this installment note, etc.? Well, it is a substantially more favorable scenario than if you received the same amount of money before this transaction. So not only are you probably reducing the total taxes paid, considering you and your transferee, assume your transferee's taxable rates, your marginal rates will be lower than yours would have been. That may be at work. But entirely apart from that is something else. You're converting income that would otherwise be taxable today if you were paid in cash for this transaction, would probably be substantially taxable today, to money that is spread out over a period of time. And also you're converting the nature of the income you receive from money that would be entirely ordinary income. In other words, if you took the income that's generated from the business or the real estate, whatever asset you transferred, the regular income that comes in would be taxed at your ordinary income rate, your top marginal rate presumably. This is to be distinguished from if you had sold the business outright, then your gain is a capital gain, the difference between your basis in the asset and what you receive. But if you held on to the asset, then you'd be getting ordinary income. So that's the comparison that's being made here. So what happens then when you transfer this business in a transaction in which you receive an annuity? We'll talk first about annuities. So the way that you do a calculation then on an annuity is that you have to use the lifespan, the life expectancy that is in the code, and that'll prescribe what everyone's life expectancy would be given your age, your gender, etc. You take that number of years and you take the value that you receive, what was the sale price, and you divide that out. That's going to indicate a certain amount of money per year. That amount of money will be a return of what your basis was. So that's return of basis, and as a result it's not taxable. So there you have income that's return of basis, no tax whatsoever. The additional portion would be taxed at your capital rate. The capital rate is going to vary, of course. Right now it's 15%. It may go up, it may go down. Most likely it won't go down. So a good portion of the portion that you receive is going to constitute that. Any additional monies that you receive is going to be ordinary income. It'll be taxed at your ordinary income rates. So you can see that the nature of this transaction is you converted part of it to annuity income, which is taxable at ordinary rates, but the other portions are going to be a return of capital, which there is no rate applied to that, and then there's a capital gain portion. So you can see how this is favorable to you. And also if you look at an installment sale, it's a similar sort of transaction. It's done a little differently. Installment sales are discussed in section 453 of the code. So when you do an installment sale, you're going to be looking at kind of three categories or types of payment that you receive. On the one hand, you're going to receive something that will be interest income. That's income that may be taxed at a rate lower than ordinary, depending on your totality of your tax picture. Otherwise, it might be taxed at ordinary rates. You're going to receive some part that's capital gain and some part that's return of capital. Well, how do you know which is which? Well, you first determine what is the amount of profit you're making on the sale, and you put that into a numerator. You divide that by the total amount that you're receiving in the sale, and that's your profit margin. Once you've determined that percentage or that ratio, then you apply that to every payment that you receive on your installment sale. And that portion represents what? A capital gain. Now, if you take instead what your basis was in the asset, you put that in the numerator and divide it by the portion that you receive, then what would that give you? That would give you the return of capital. That's the part of the payments that you receive that's not taxable because it's considered a return of your original investment. But let me tell you that the IRS does require that you recognize interest income on whatever outstanding balance there is. So whatever the outstanding amount is that's due along the way on your installment sale, you got to recognize as interest income that portion that's outstanding, and you have to apply a rate to it. So this may in fact exist that you are receiving money that reflects that, or it may be simply imputed to you by the IRS. But the IRS is saying that it's an economic reality that there's a loan here in effect. And so some portion of these outstanding proceeds, of this outstanding balance when you receive a payment, must be interest income. So that you determine the rate by looking at the schedules in the code, and you go from there. So you have the interest income component, you have the return of capital component, you have the capital gain. But you can see where, when you look at this, that it can be very advantageous to do an installment sale. The bottom line is that when you do an annuity sale or you do an installment sale, the opportunity exists to defer income, opportunity exists to convert income that would otherwise be ordinary into capital gains income or interest income.